In this video, we're going to be doing a bit of a breakdown of some of the growth and unit metrics which investors want to know. And the reason we're doing this is that over the last sort of couple of years, one of the biggest trends that we've seen is that for a lot of companies, one of the challenges is that having a good idea just isn't enough anymore. And that used to be okay in the startup space. And just given the progress of the entire space, a lot more investors are asking for metrics and they want to see it often before they're even having conversations with the companies. So what I thought I'd do is I'd break down some of these sort of growth metrics that investors are looking for and also some of the unit metrics. And if you understand these, then it'll really help you prepare when you're going into a conversation with the investor, especially if you've got them prepared. So the first one I'd love to go through is called your customer acquisition cost. Now, this is typically what they refer to as the magic number. And this is definitely important for subscription businesses. So if you're a subscription-based business model, investors really do want to understand what your customer acquisition cost is, right? So how much does it cost you to acquire a customer? Now, there's different ways in which you can calculate this, but to simplify it really, it's how much do you spend on marketing, both in terms of the actual cost you spend on marketing and then also team members' salaries to acquire that person. So for example, if I'm trying to figure that out for myself, we have two people on a marketing team, right? They would be included. Then also you have people sort of whether it be SDRs or sales development representatives or BDs, etc. Most of the time it will just be SDRs, but typically for some earlier companies it will just be BDs. Their salaries will also be included if they're proactively out there looking to attract potential customers for your business. That would also include it. So it's not just the marketing cost of what you spend on your sort of external promotion. It also includes the salaries of the people involved in the lead development, lead generation process as well. So when you can understand those metrics as far as, okay, you can break down, okay, how much does it cost you? How much did you spend? If you look at the last sort of 3 months or 6 months, how much did you spend in that area? And then if you look at what revenue you generated and simply divide the two, and then from that, you'll come up with your customer acquisition cost. Now, once you understand your customer acquisition cost, the next thing that an investor is going to be looking at is, well, how much revenue do you generate in that 1 year? So it's effectively the replacement time frame. Now, if you can understand, so if, for example, if you charge, if it costs you $3,000 to get a customer, and in the first year of getting that customer, your revenue is going to be $2,000, then the investor straight away understands that there's effectively an 18-month time frame for basically you to hit break even on that potential customer. And then I'll go into what they really want to understand the next metric, but it's really just understanding how much effectively money is going to be required for you to basically start scaling your business. Now, if that's completely out of whack, then that's going to be a massive red flag for a business. So for example, if it costs you $5,000 to get a customer, but yet the revenue you generate per year from that customer is $2,000, then that's going to be a massive concern for them because effectively you've got to be basically, you got to have that customer for at least more than 2 years before you get your money back. So they know your business is going to require a lot of capital to successfully scale. Now, of course, you could have incredible growth rates, and I'll get onto the growth rates that they're actually looking for in a second. But that just helps you with some of the numbers straight off the back. So customer acquisition cost is really important, and then customer acquisition cost, and then the yearly revenue you generate from that customer is important. The next thing to understand that investors do want to know is your lifetime value of your customer divided by your customer acquisition cost, right? So that if you can work out the lifetime value of your customer, it's basically how long will your customer stay with you and typically what revenue can you generate. Now, if you're very early, it may be hard to come up with this number, which is hence why I also suggested the yearly metric as well, just so they can frame in their minds how much money is going to be required to fund the growth of your business. But the lifetime, if you've been around for sort of 3 to 5 years and you can highlight the lifetime value of your clients and the actual, and then divide that by your customer acquisition cost, you can paint an incredible picture about your business, said if the numbers stack up. So we had a client that didn't quite understand these unit metrics that investors were after, And effectively, some of their clients had been with them for 8 years, and their churn rate, they actually hadn't lost one client in that time, right? So they'd been going for a lot of time. And when you actually broke down their customer acquisition costs, when we actually broke down the lifetime value of their client, and then when we divided the two, the business had an incredible upside that if they were able to communicate that to investors, they would have no issues in raising money whatsoever. And this is why it's important to communicate those metrics, because for this company, they sort of found it hard to articulate the market they were going after. But I just know in dealing with investors, the metrics for them, for their lifetime value of their client divided by their customer acquisition cost would have just been too hard to resist for them. So there's some important things to kick off with. Now, some other unit metrics that investors are looking to understand is obviously one of the first ones is they want to understand what if you're very early, your monthly recurring revenue is, or your annual recurring revenue. Now, some companies like to highlight their annual recurring revenue run rate. So there's two ways. You can highlight what you did last year for your annual recurring revenue, or you can highlight what it's called a run rate, which is basically your prediction for this year based on what you're doing right now. Now, there's another way you can actually define that, is you can talk about your year-on-year growth, right? So investors are always looking for businesses that are growing, and typically, ideally you want to be sort of above 40 to 50% a year, but if you're a high growth business, investors are looking for 100% plus per year growth. So typically you find the companies that have the easiest time attracting investment have greater than 100% year-on-year growth, or very, very early, 20% plus month-on-month growth, right? So effectively they call it the double triple. So the double digits monthly revenue, and then the triple digits in the yearly sort of revenue growth. So effectively said, these are the kind of metrics that you want to be communicating to potential investors. So far we've gone through the customer acquisition cost, the annual revenue divided by the customer acquisition cost. We've also gone through the lifetime value, the LTV divided by the customer acquisition cost. We've also talked about the annual recurring run rate, the monthly recurring run rate, and we've also talked about how to communicate the growth as well. So if you've got an ARR, if you've got an annual recurring run rate, let's call it of 3 million, but that's an increase of 150% on last year, then you want to be communicating that year on year that you've been experiencing 150% growth, right? So for an investor's mind, that helps to position it very quickly, how the business is performing. And then the next thing that they're going to be trying to understand is what is your actual gross margin? So, what is your revenue minus your cost of goods sold, right? So SaaS businesses, they have a different way in which they calculate the COGS, right? But just look it up for your industry, look it up for your business. But communicating gross margins is super important, right? Because it helps them understand the potential cash generation machine that your business could become over time, right? Once it gets past the different areas. So in putting these metrics together, I said they can start to form a very clear picture of the potential growth, the growth potential of your business and the financial results that you'll be able to achieve over time, assuming you stay on course. And then the last one is they want to understand, potentially not straight off the bat, but some larger investors, they will want to understand what your current cash position is and your cash burn rate, so they can understand effectively when you're likely to run out of money, at least from a positioning standpoint. And this helps set up different timing for capital raisings going forward. And likewise, it may even help you understand different benchmarks that you're trying to achieve in that time. So let's go through those different ones again, because I think it's really important. The first one is understanding your customer acquisition costs. It's very important. Understanding your customer acquisition costs versus your yearly revenue from the company, from your client. Then understanding your customer acquisition cost divided by your lifetime value of your clients. That's the amount of revenue you generate per year, and then how many years your customer will stay with you, or months if it's monthly revenue. Your gross margins, which is your revenue, right? Which is your revenue or your cost, your basically revenue you generate from a sale minus your cost of goods sold. And each industry has their variation of cost of goods sold, so just look that up for you. And then also your current cash position. Now, we did also talk about, in communicating to investors, helping languages like annual recurring revenue or monthly recurring revenue, or highlighting month-on-month growth, or year-on-year growth. So month-on-month growth, investors said that the ambition that super early companies are going for is to show month-on-month growth of greater than 20% and yearly growth of greater than 100%. So they call it the double triple. Or the triple double, whichever way you want to go. For some companies that have been around for some time, really you're trying to position yourself as growing as sort of around that sort of greater than 40 to 50% when communicating to investors. Now, if you aren't achieving this at this current stage, then you need to have some sort of explanation as to why, whether it be market forces, internal challenges, etc. But effectively, when you're lining out your plans for the use of capital, it really has to speak to how you can invest that capital into the business to in turn create those results going forward. Now, for life science businesses, this is not even relevant for you whatsoever, and for a lot of probably the more deep tech businesses, because effectively what you're looking to go through is different technical milestones that's important for investors to see. So I hope that's helpful for you in understanding the different growth and unit metrics that investors are looking for when you're going to raise capital. Look forward to providing more videos shortly.